So we'll start off with derivatives, right? So the topic will be derivative markets and instruments. Underlying asset based on which the value is derived. You have different type of derivatives. The most important ones are forward and futures. So forwards are not exchange traded and they are over the counter. So when I say they are not exchange traded, it means that it's over the counter, which means that the deal is outside the exchange, right? Whereas when you speak about futures, futures are exchange traded. There's an exchange protection. Party on the other end who's liable to pay you the money. Whereas in forwards, if the default risk is higher, right? So what exactly is a forward or a future? So when I say forward, I need an underlying asset, right? So we started off the lecture with there has to be some underlying asset, X, and let's say that's trading at $100. You can get into a forward contract saying that, let's draw a timeline. The value of the forward is now, correct? Let's say 3 months from today, which means that in every forward contract, there are two parties, correct? A, B. So A has to promise something to B. So there are, I will buy the asset, maybe $105. B will say that I'm ready to sell the asset at the same price, right? Which means that B is bearish and A is bullish, right? A wants to buy the contract and B wants to sell the contract, right? So that means B is short on the contract and A is long. So just to give a quick example, Nifty in India has futures, correct? Futures, they trade on the exchanges and every month has a contract. So if I say Nifty March futures, Nifty March 20 futures, that's 2020 or let's say 21, whatever month that you want to put down here, that's all right. Nifty March 20 futures, let's say it's going at 15,000 to 80. The buyers and sellers agree upon this price. That means each time you see a price update, it means that there's a contract that's created between a buyer and a seller, or a contract that is closed. It can be either. Okay, but you don't need to get into those dynamics. But ideally, what you need to remember is these contracts are created between buyers and sellers when they keep agreeing on a particular price based on the direction they think an index might move or a stock might move or anything else. I just used the example of Nifty. This can be done on commodities. This can be done on currencies as well. It can be done on stocks, indices. Certain exchanges now even have cryptocurrency futures.
Oh, yeah.
Right? So you can create this underlying contract on anything because any two people, all you need to create a forward contract is two people, right? Nifty futures, this is primarily traded on the exchange. So if it's traded on the exchange, it will be called futures. Okay. We'll go to the next bit. You would have heard of two types of systems, right? You have forwards, which we just spoke about, and you also have options. Okay. Forwards are called commitments. Forwards are called commitments, right? Options are called contingency claims. This in a little more depth. If an event occurs, you have the right to claim something. So you have the right to claim. Okay, we'll be getting into what options are, call option, put option, etc. But just to give you an example, I will come to you. I just break this down and explain this in simple terms. If I come to you and say, if I want to make a bet with you, I'll just be like, hey, I'm going to bet 5 rupees that the stock markets are going to hit 15,100 today. Nifty, the index is going to hit 15,100 today. Now you'll say, okay, I'm in on that bet. So you will take my $5, right? We have 5 on the table. So if it crosses that, you have to pay me $5 more. So the $5 is the bet, right? If it doesn't cross, I have to pay you $5, right? So the contingency claim generally has a side where it depends on the price at a future date. Now, futures, how is this previous part that we discussed different? Two parties are committing to sell, right? They can't say that, you know what, I'm not selling, I'm not buying. They have to sell and buy. They have to sell and buy. Whereas in options, because I'm giving you the money initially, I'm telling you, I'll give you 2 rupees if I'll give you 10 rupees if the markets cross a particular threshold. You will say, okay, but you didn't give me any money in the beginning, right? You didn't give me any money in the beginning. There was no exchange in the beginning. Just as uh, in forwards also, there is no exchange of capital in the beginning, right? If you notice, in forward, it's saying that if something happens, you're just agreeing upon the price. You're just agreeing upon the price. That's it. There is no actual exchange. Even in options, there is no actual exchange in the beginning except cash. There's no actual exchange of the underlying asset even in options. In options, I'm going to come and give you 5 rupees and say, if this crosses a particular threshold, then you have to pay me. If it doesn't cross, you keep the money. So I am actually creating a contingency claim. I'm creating a claim by paying you a premium. Okay. So again, we have not gotten into what call options and put options are. This is a very layman's explanation. It's just saying, okay, I'm going to come and give you $5. If this happens, if it crosses a particular threshold, then you better pay me whatever it crosses. And let's say Nifty hits 15,200, you better pay me the difference of what we agreed upon. So if it crosses 1,500, you have to pay me $100 if it hits 15,200. If it hits 15,300, you pay me $200. Okay. But I will only give you $5 for that. If it doesn't cross, you keep the $5. Right. So essentially, you are only taking money from me because you're agreeing to the bet. You're agreeing to the bet. That's it. But there is no exchange from your end. So an example to prove this. So you have a stock that is trading, stock X that is trading at $100, right? Uh, A tells B that 3 months later, A will buy $110. B will sell at the same price, right? So they've entered into a forward agreement. Let's say 1 month from today, or let's say 2 months from today, we'll say this is the agreement, right? 110 is the agreement. This is the, let's assume that this is the agreement date. I've not written a date. In futures, you even specify the date, right? You have to say that at this particular date, on this particular date, right? Not, it can't just be 3 months from today. Even 3 months from today, they'll specify the date. Okay. So here, I started at $100, right? Let's say that after 1.5 months, this stock is trading at $115. You as a seller will be scared because you've made a commitment, right? This is over the counter. Remember, we're talking about forwards. At this point, you'd be scared as a seller. Oh, this is at 115. And as a buyer, I would be scared. A would be scared that B might default. Why? Because this is over the counter, right? B is honest. B will be scared about the loss. A would be scared that B will default, A will be happy about the profits, about the unrealized profit. Let's call it unrealized profit, right? So on the settlement date, what is settlement date? That is the third month. Third month end, right? As agreed. Let's say the stock finally hits $121. Here, the profit to A, $121 minus $110, right? That is $11. Loss to B is minus $11, right? Because B will have to go and sell it, buy it at a higher price from the market and then sell it to A at 110, right? Because that was the promise. So I'll connect this back as per the promise. I just call it promise. In technical terms, this is a commit. Okay. So we'll extend the same discussion to futures contracts, right? When you take a forward and standardize it, it has specific sizes. So they are called lots. Let's say 1,000 shares at $50, right? This is a standardized contract. This size, this is called lot size. And second thing, as mentioned earlier, it's exchange trade. Regulation is greater, which means there's less chance of a default. What's a clearinghouse? Clearinghouse is basically the one that helps with margins in the account. Futures contracts are also cash settled or deliverable. Most contracts are cash settled, but recently there was a law passed in India. And in India, I think a lot of stocks are now deliverable, right? But otherwise, right, mostly cash settled. We make a table and we'll talk about primary features or what you need to remember about futures and forwards. This futures are traded on exchanges. Forwards are traded over the counter, right? Futures contracts are standardized, whereas forwards contracts are customized. Here you have a clearinghouse. Forwards don't have a clearinghouse. It's between two parties. This is regulated. Regulated means, there's some government interference, right? Not regulated. What's the settlement price? In fact, settlement price is an average of the prices during the final few days of trading. That is prior to the settlement date. Let's say that we agree to sell something, we enter into a contract and it's 30th March, right? It's not that they take the price on 30th March. It's an average. Why? Because you don't want manipulation, right? So because otherwise, some big guy, I'll pay money to another guy and be like, can you drive up these prices? So you want to curb any sort of malpractice, and which is why you introduce this sort of averaging. You can't manipulate the market for a few days. You can't manipulate the markets for billions over a few days. Of course, it has been done, which is why these laws and regulations actually started coming into picture, because someone would have found a loophole to this. Because if I say it's the last second's price, then you'll start thinking back, oh, okay, it was the last seconds, I can push the prices up and then close out my positions and probably book the gains. So you don't want any sort of manipulation there. And that's why they restrict it to a particular type of system, that is the average of the prices. Okay. Now, in the forwards and futures market, another important term is open interest. Open interest is very simply, see, whenever A and B get into a contract, right? Now, if I say C and D get into a contract, this is one more contract, correct? Now, if I keep adding these, the sum of all contracts is equal to N. That means there are N contracts, right? If there are N contracts, this N is the open interest. Right? Open interest refers to the number of outstanding contracts. Right? And it has to be of a particular type. So, for example, USD INR futures. The reason I'm saying outstanding is, suppose A and B get into a contract and another party C comes and C takes the place of B. Right? So, this contract, what does it become? It becomes a contract between A and C now. Right? B will exchange it with C. That means C will buy it from B. Right? So, B is out of the contract. So, A has a contract with B. B has a contract with, sorry, A has a contract with B, and C comes in and replaces B. That's not the creation of a new contract. Actually, super important. It's margin, right? Margin can be thought of as security deposit. That means when A and B get into a contract, this security deposit is called margin. So if I have to get into a, let's say, 1 lakh contract, right? I have to deposit a part of this, maybe 5% as specified. So for 5,000 rupees, 5,000 rupees, I can get into a contract that is worth that much, right? It's worth 100,000. But you have to deposit this, and both parties will deposit this much. Based on the movements of the day, you have to increase and decrease this. Based on the movements in the day means A is long, and if B is short, right? And this, let's say this stock, finally this contract actual value goes up to rupees 110,000, right? If A is long, who's winning? A, because the contract is for this much. B is at negative margin now because this 5,000 is wiped out here itself, right? So what does B have to do? B will have to deposit even more money to actually cover this up. They started at 5,000. Now A doesn't need to keep this much, but this is an initial margin, A, but B has to increase the margin.